Hello students. Then let's practice about the relevant information for decision making with a focus on operational decision in deletion or addition. Let me read the question first. Consider a discounted department store that has three major departments: groceries, general merchandise, drugs, and management is considering dropping the grocery department, which has consistently shown an operating loss. The following table reports the store's annual operating income. As you can see, we have the total amount of this company, and this company has the three department store, the grocery, general merchandise, and drugs. And then the problem is the grocery department. The grocery store actually makes the operating loss, $10,000, even though the grocery store is making the contribution margin, but the fixed cost is greater than the contribution margin. So assume that the only alternatives to be considered are dropping or continuing the grocery department, which has consistently shown an operating loss. Assume further that the total asset invested would be unaffected by the decision. The vacated space would be idle and the unavoidable cost would be continued. Should the management team drop the grocery department? Okay. Now we have to use the incremental analysis. Incremental analysis is just considering the changes before and after. So that is the the important process to identify what if we drop the grocery store, what would happen into the company. Okay, that is the point of the incremental analysis with only relevant information. To do so, we should retrieve this information, the total before change, 1,900, then everything from this table, less avoidable fixed cost, the supervisory salary. So we take the avoidable, the fixed cost apart from this unavoidable fixed cost to identify what is the profit contribution before the unavoidable fixed cost. So we identify the profit. Profit is 215. Okay, then less unavoidable fixed cost, which is common space, is now 180. So operating income. Anyway, we have the same result, 35. We just reclassify the order of this fixed cost to distinguish it between this avoidable fixed cost and unavoidable fixed cost in order to put the relevant information onto the changes of the dropping the grocery department. Now we will calculate total after change from total before change minus changes of dropping the groceries. So we will retrieve the exactly same amount of the sales or the cost from this table, because we will calculate A minus B column. So the sales is $1,000 will be reduced if we drop this the grocery department. Also, this 800 is going to be reduced if we drop this grocery department. And then let's avoidable fixed cost. Avoidable fixed cost 150. And then you can see that the profit contribution to unavoidable fixed cost, which is irrelevant information, right? This unavoidable fixed cost is irrelevant information. So we do not put anything on it, even though the common space is 60. The reason why it is the irrelevant information is that regardless of the company choose dropping the grocery department or not, this $60,000 is the fixed unavoidable cost. The company cannot avoidable, right? Cannot be avoidable. That's why the changes in the changes column, we do not put anything. Again, in the incremental analysis, we put only the changes of the dropping the groceries from the existing the information. So this common space unavoidable cost for $60,000 for the grocery department is irrelevant information. So let's calculate again the operating income. Actually, the operating income, if the company drops the grocery department, the company will lose the $50,000 operating income. In fact, so let me show you how comes. Now, $900,000 will be reduced after change. Oh, sorry, the $1,000 will be reduced. So the total after change is 900, and then total variable cost also. I'm going to just drag down. So as you can see, the $15,000 is going to be reduced if we drop the grocery department, because this is $60,000. The operating income $10,000, operating loss of $10,000 is not avoidable. Is an avoidable part, but the $60,000 for the common space is unavoidable part, right? Unavoidable part. So the $50,000 profit contributions will be reduced if we drop the grocery departments. That affects this $35,000 operating income to negative operating income, the operating loss, $15,000. So if you are the manager of the company, you cannot drop this grocery store just by looking at this $10,000 operating loss. So you need to consider if even though this department is making the operating loss, if the department creating the profit contribution to unavoidable fixed cost, which is positive, then okay, we can still hold this department. We can still produce. We can still run this grocery department. Okay, then next, let's assume that the store could use the space made available by the dropping of groceries to expand the general merchandise department. Now, this will increase sales by 500. That is the relevant information, because it is incremental changes. Generate a 30% contribution margin. That is a new contribution margin produced by this $500,000 sales increase, and have an additional fixed cost, $70,000 for supervisor's salary. Also relevant information. That is relevant information. Now let me retrieve all this information from the previous we completed. Okay, let's start. Let's incremental changes of the dropping groceries, and then we will add this incremental changes of expanding general merchandise. General merchandise should starting from 500,000, right? 500. That is only the incremental changes. Please ignore this $800,000. That is not the incremental changes. The incremental changes in sales is $500,000 by dropping the grocery and expanding the general merchandise. So 500 is increased. Then how much is the variable cost? How much is the variable cost? Let me calculate first. Here the gross the contribution margin we are given is 30%. So the 30% times 500, which is the sales. So we got the 150, the backward. So this variable cost can be calculated, the difference between the sales and contribution margin. Got it? And then What is the avoidable or additional fixed cost? Now, here we are. We have to put the $70,000 additional fixed cost, $70,000, the supervisor's salary, when we expand the general merchandise. Okay. Then we have still profit here, 150 minus 70, now 80. And then let's unavoidable are the fixed cost. Unavoidable fixed cost. Do we have unavoidable fixed cost added? No, we don't. So 0. So the operating income here is 80. Now let's calculate A minus B plus C. That means that before change minus dropping grocery, the impact incremental changes of dropping groceries, and plus the incremental changes of expanding general merchandise. So 190 plus minus 1,000, the incremental changes, the reduced amount of sales, then plus expanded the sales. Okay, so we can increase total after change. We can decrease 1,000, increase 500, then we can produce 1,400. Let me just drag down. Then what happened? What happened in the operating income? In the operating income part, what do you see? Yes, here we increased from 35 before changes, after dropping the less 50, even though we lost the $50,000 like previously, then we reduced the 15, but we could increase 80 so that we can produce 65 operating income. That is the after changes. So definitely we can make a decision that we drop grocery store and expand the general merchandise. Again, please remember that the profit contribution to avoidable fixed cost before this unavoidable fixed cost, this profit is good indicator that indicator if we decide to drop or the add or deletion or addition operational decision process. Okay, see you in the next video clip. Bye bye.